So there's this long standing debate about what's better, buy term invest the difference or using whole life insurance and then doing that. Now there's plenty of things on the internet here. I want to take it one step further. What if it wasn't just buy a term and invest the difference versus doing whole life or infinite banking? What if it was instead not buying any term at all, just taking a savings account and comparing that to a whole life policy, specifically the way we design it. Now I'm going to start with this. You want to hang on here because if you actually want to see the numbers and how it really works and why I as an investor actually do this, you'll see why it makes a no-brainer. It's a total no-brainer why you do that. But we got to make sure that things are apples to apples, that we're really comparing right numbers, no funny math, but we're doing this in a way that you guys get. Now, if you don't want to hang out till the end, if you don't want to have to see all the numbers and stuff, great. I'll just tell you, if you're not sure, the way that we do the infinite banking, I call it max ROI infinite banking, it wins. In fact, after 10 years of buying investment property, real estate property, using a savings account versus using your whole life, it would actually make about a 40% difference in 10 years. That means you're averaging about a 4% better return per year using your whole life versus just using a simple savings account. But if you want to see the numbers, hang on because here we go. I'm not just pulling numbers out of thin air. This is legit. All right. So I'm taking an example here of someone who is putting in 20,000 a year into this policy. Now, as you do that, you notice after 3 years, they've put in 60,000. Right now, the cash they have available to use is 54,000, right? Just over 54,000. And we're going to borrow $50,000 to go buy a real estate property. And we're going to say this real estate property with this $50,000 down payment will pay them 420 bucks a month or about 10% a year. That's the typical property I like to go for when I invest in my properties. Usually I like better than that, but I'm being very conservative just to play devil's advocate here. Now I'm going to compare this to a savings account where you were already paying 20,000 per year. You have about 60,000 bucks. Now the savings account, we know pays point nothing percent and you get taxed on point nothing percent. I'm going to show it at 0.1%, which is double what my credit union is paying me currently in the current environment here in early 2022. But I want to kind of show that because really, if you had a savings account, you would have about a $6,000 advantage here, right? So already you're falling behind. Now, if you bought term policy, yeah, you might be pretty similar or pretty close to this point. But again, I want to compare to those that just think from an investor perspective, like I think from, versus just doing this policy, right? So here we only have 54,000. So we're going to borrow 50,000 from the policy. We're going to get a bank line of credit against it at 4%. Now the policy here is paying over 5% tax free. Usually it nets about 5% a year in this particular scenario. So again, you should only be making a 1% spread because if you make 5% and you pay 4% for getting that bank line of credit against it, because the policy, the cash is collateral, you get a secured line of credit against it, you should be only making 1% more. Now, that alone, if you just use pure math, 1% is better than a savings account where you liquidated it and then it's gone, right? You're not earning any money on it. But I want to show you still because it's not just the 1% difference. That might sound small, but it ends up being very big. So again, your savings account, you put in 60,000, you pulled out 50, you'd have 10,000 left, where in here we only have about 4,000 left. So I'm going to show the savings account first. You start with, again, I said $10,000 in that year 3. You've got 20,000 a year that you're adding to this for just 4 years because I want to be apples to apples with this life insurance. That's the one way that sometimes these life insurance guys get a little tricky with it, is that they're adding more money to it so it looks better. So I want to do the same thing. Keep adding 20,000 a year to the savings account as you're building up to invest, plus the cash flow from the investment, which is 420 a month or 5,040 a year. That's why you see 25,040. Now you're not adding anything more than that. You're just putting that per year. You have interest rate at 0.1% and savings account, like I said, 4 years, because that's the number of years you're still putting money into that policy. So we do that to get 110,380.86. So to get the other 6 years, because I was only 4 years in, I put that number in because that's now the new number. Now it's only 5,040 because we're not putting 20,000 a year into the whole life policy either at this point. We're going to do this for 6 years. Notice I put the tax rate only at 24%. If you're in a higher tax bracket, this is actually more dramatic. But I did this as more of just the typical tax bracket for a middle-class person. All right, so we put that number in, 141,205. That's how much you have in savings after you've saved all the cash flow from that real estate over the last 10 years, plus the 10,000 plus whatever interest you earn. Obviously, you haven't earned a whole lot of interest because it's a crappy savings account, right? And you get taxed on that point nothing percent. Now, let's compare that to the whole life because remember, they have insurance costs coming out too. So it's not fully just growing without anything bogging it down. There are some insurance costs. Now, the way we design it, this could be different. This will be different with almost anybody else. But the way we design it, we do minimal cost coming out. So this is why it does better. So I did the same thing. Now we'll see here, year three, we of course took that money out. There's those 1, 2, 3, 4 years, 20,000, and then nothing for the next 6 years. So year 13 is that end year. Now, notice there's now $208,739 after 10 years. That is more than what we had just seen here at 141,000. But we got to subtract out whatever's left on the loan, right? So we go in here and we do a little simple loan calculator. We took the loan out for $50,000 over the course. I'm going to put this as 12.659. I believe that is going to give us, and then at the 4% the loan rate right now. So $420 a month right there. If I really want to be super duper accurate, I'll just do this just for your benefit. Boom, there it is. Okay, now you look at the amortization table because what we're doing instead of paying the cash flow from the property back into your savings account, instead of putting the savings account, we're just paying down this line of credit that the bank has against our life insurance. The life insurance grows regardless. It grows the same way, nothing changes. So that's why we can show you that number easily, right? And by the way, that's based on current rates. If interest rates go up on the life insurance, because if interest rates keep going up overall, they also go up on the life insurance. So the numbers would be bigger. But we're just keeping it at current values right now, being very conservative on this. So if you look at the amortization table, we go all the way to the end of year 10. The loan balance is right there, 12,696. So what does that leave you with? That leaves you with 196,043 bucks. And actually, I'm just going to round down, 42 bucks. So you have 196,000 just over that versus the 141,000. So right there, guys, that is a $55,000 difference after 10 years using the whole life, not even buying term. Remember, if we bought term, you would have even less money on the savings account side. I took that equation out. I just said you didn't want any insurance. We're comparing to using this almost like this is a tax-free supercharged savings account. Want to make that kind of comparison. And all of a sudden, look, we got a $55,000 difference. What does that mean? That's about a 39% difference, 39% more in the whole life versus what you had in the savings account. Even with all the insurance costs coming out, you still have more. This is why, again, like I said, if you're making a 1% spread plus you're making 10% on your investment property, that's 11% plus. That's good. But that 1% is compounding, it's building and growing and becoming much bigger than 1%. As you just saw, that's almost a 4% average over 10 years. That is a huge difference. So the question is, do you want to make $55,000 doing nothing extra? Or you want less? And imagine what that number is if it's being bigger. If you're using this more than just for a $50,000 little property, what if you're using this for hundreds of thousands of dollars? What if you end up using this for millions of dollars that you've been investing over not just 10 years, 15, 20? It gets bigger and bigger. The spread gets huger and huger over time because you are making a better return tax free. Not to mention, it's protected from lawsuits and creditors, and you can access that money whenever you want. It's liquid and available to use the way you choose to use it. So, from an investor perspective, I want control and I want the maximum return possible. That is why I use these kind of policies. My big point right here is that we really want to get the best ROI possible, right? We want the biggest bang for our buck. That's how you do this here. Now, if you got more questions, you always go to, you can go look at our playlist here on the Money Ripples with Chris Miles page. We got all these infinite banking playlists you can check out and get more, plus the one that's recommended right here. But I hope this helps you understand that we use this because we want more leverage, better returns, less taxes, and be able to get our money working for us in two places at the same time. So go check out these other videos we got for you here.